Incoming Fed Chairman Kevin Warsh, your mission, which you have chosen to accept, is simple: to simultaneously defeat inflation, preserve Treasury market stability, prevent a debt rollover crisis, avoid a recession, maintain confidence in the dollar, and somehow keep asset markets from breaking under the weight of higher real rates. No big deal. Ho hum. This message continues. Those goals increasingly contradict one another. And the reason this matters is because most retail investors still think the Fed chairman is an economic king. He is not. The Fed chair is closer to the CEO of a committee-controlled hedge fund with political constraints, institutional inertia, and global bond vigilantes watching every move. That is why Warsh's task is likely impossible. The market narrative says, new Fed chair comes in, cuts rates, saves the economy. But that assumes the Fed operates in a vacuum, and it does not. The Fed operates inside a global macro trap, and that trap is tightening. First, understand the structure. The Federal Reserve Board of Governors is deliberately designed to resist rapid ideological change. Governors have staggered long-duration terms specifically so one administration cannot fully capture monetary policy overnight, which means even if Worsh wants materially easier policy, he still has to build consensus. And now let's go through the governors. First, you have Jerome J. Powell, institution first, credibility focused, moderately hawkish on inflation after getting burned in 2021, calling inflation transitory. Powell's legacy now revolves around not repeating Arthur Burns era mistakes. You have Philip Jefferson, I'd say generally dovish academically, but cautious institutionally, more labor market sensitive. Now you next have Michael Barr, heavily focused on banking system stability and regulation, more concerned about systemic fragility than market upside. Then you have Michelle Bowman, traditionally more hawkish on inflation and skeptical of excessive regulatory overreach. Next, we have Lisa Cook, generally viewed as dovish and employment sensitive. Then you have Adriana Kugler, labor market oriented, more willing to tolerate somewhat easier policy if employment deteriorates. And then Christopher Waller, one of the more intellectually hawkish members when inflation expectations become unanchored. And now you insert Warsh into the mix, and here's where things get fascinating. Worsh is not actually a pure dove. The media narrative is wrong. He has criticized excessive QE, endless balance sheet expansion, and the Fed's addiction to liquidity support. So he may favor lower rates under certain conditions while simultaneously wanting tighter balance sheet discipline. That combination is extremely dangerous for markets because Wall Street has become conditioned to believe lower rates equals more liquidity. But Worsh may attempt lower rates plus balance sheet reduction, and that is a completely different regime. And if you don't understand that distinction, you're going to misread the next cycle. The real problem is that the Fed is no longer controls the environment the way it once did. Look at the macro backdrop. U.S. debt levels have exploded. Treasury issuance is massive. Interest expense on the national debt is becoming one of the largest federal expenditures. And at the same time, geopolitical instability is reflationary. Energy shocks, supply chain fragmentation, tariffs, defense spending, deglobalization. These are structurally inflationary forces. The old disinflationary globalization machine is breaking apart in real time. And that means the Fed cannot easily return to the 2010s zero-rate world without risking a loss of confidence in the dollar and Treasury market. This is why task becomes impossible. If Worsh cuts aggressively, inflation risk reignites. then bond yields may rise. Anyway, the dollar probably weakens and commodity inflation probably surges. But if he stays tight, regional banks remain pressured, commercial real estate deteriorates further, refinancing risk accelerates, unemployment eventually rises, equity multiples compress, and you've got to pick your poison. And now layer in perhaps the most important variable of all, the bond market. The Fed can influence the front end, but the long end increasingly answers to global capital flows. If foreign buyers reduce Treasury demand while U.S. deficits continue expanding, long-duration yields can rise independently of Fed cuts. And that is the nightmare scenario. Let's walk through it. The Fed cuts. Mortgage rates don't fall. The Fed eases, and the 10-year Treasury rate rises anyway. That destroys the traditional monetary transmission mechanism. And there are signs this risk is already emerging. Recent Fed minutes show increasing internal disagreement and a growing willingness among officials to tolerate tighter policy if inflation remains sticky. Meaning Worsh may enter office at the exact moment the committee itself is becoming more hawkish. And that's the irony. Markets initially viewed Worsh as bullish for risk assets. But the institutional reality may force him into a much more restrictive posture than investors expect. And here's the deeper truth most retail investors miss. The Fed today is not fighting one problem. It is fighting multiple conflicting systems simultaneously. Inflation, debt, asset bubbles, bank fragility, treasury market liquidity, political pressure, dollar reserve status, global deglobalization. And there is no clean solution anymore, only trade-offs. So how should the retail investor position? First, stop thinking binary. This is not stocks up versus stocks down. This is a regime shift. Second, avoid excessive duration risk. Long duration bonds become dangerous in structurally inflationary environments with rising sovereign debt burdens. Third, favor quality cash flows. Companies with strong balance sheets, pricing power, and real free cash flow matter more in higher rate worlds. Fourth, own some hard asset exposure, not because the world is ending, but because monetary credibility cycles matter. Energy, selective commodities, precious metals, real assets with cash yield. Fifth, avoid maximum leverage. The 2010s rewarded leverage because capital was nearly free. That era is pretty much over. And six, hold dry powder. Volatility is no longer an anomaly. It's becoming the base case. And the next decade may reward liquidity and patience more than blind, passive exposure. Because the biggest takeaway here is this. Kevin Warsh's impossible task is not really about Kevin Warsh. It's about the financial system that became dependent on permanently declining rates, permanently expanding liquidity, and permanently suppressed volatility. And history suggests those kinds of systems eventually hit a wall. The Fed can delay that reckoning. It probably can't eliminate it. And now you know the possible story. Build that stack. iBankerU. Good day.